Hello everybody, welcome the Teenage Investor here. Today we're talking about public versus private companies. We're talking about the pros and cons of each, and we're going to be contrasting them in this video. So listen up. Firstly, what is a public company? So number one, a public company sells ownership in its business to individual investors or investment firms. Number two, it trades publicly on a stock exchange. The way it sells ownership in its business is by trading publicly on a stock exchange. And number three, and finally, it must report earnings in the format of a 10Q quarterly every 3 months and a 10K annually every year. Pretty much what these reports tell the investors is the financial situation of the company, so it can let us know how the company is doing, how much cash they have in the bank, how much revenue they're getting, and their growth. Okay, now what is a private company? Well, number one, it's not publicly traded on a stock exchange. So if anyone wants to invest in the actual company, they will have to do it privately, and they will most probably have to know the owner personally. And number two, usually few partnered owners or a small group of investors own the business. So most of the time it's a local company, and there's one or two people that own the actual business, but sometimes it's a small group of investors that own the business along with a few partnered owners. So the pros and cons of a public company. First, we have the pros. Number one, there's lots of available capital. When a company goes public, they IPO on a stock exchange, and what that means is that they go public for the first time and they sell parts of their business in return for capital, cash. So when an investor invests his money in the business gets a lot of capital from selling all those little pieces of the actual company. And number two, owners reduce risk of losing their money. So when investors are invested in the actual business, that means that the owner owns less of the company. This could be a good or bad thing, but on the pro side, if the business doesn't do as well as they expected, they don't lose as much money as they would have if they are the sole owners of the company. When there are investors involved, if the company doesn't do well, then the owners lose less than if they would own the entire business themselves. So now the cons of the public company. Number one, there's a lack of privacy. The major reason that many companies don't go public is because there's a lack of privacy. You have to reveal everything in those 10Q and 10K reports that is reviewed by the SEC. So basically, you can't lie about anything. You have to reveal every single thing that is happening with your financial situation of your business. Number two, there's a difficulty of formation. Before becoming a public company, you have to assemble a board of directors, and basically those board of directors have to make decisions for the business in the interest of the investors. Number three, there's legal formalities. When filing all those different documents, 10Q, 10K, there is a lot of rules and regulations to follow before being able to submit it, and it's always audited and reviewed by the SEC. So you have to be very, very accurate with your numbers, or else there will definitely be consequences. And number four, there is a delay in decisions. So since there is a board of directors and many individuals making decisions for the business, it may take a long time before an actual decision is made on anything that goes on within the business. Finally, we have the pros and cons of a private company. So the pros, number one, complete and major ownership in the business. This could be a good thing also, because if the company does do very well for itself, then the owner profits from it majorly. Number two, quick and easy decision making. So you don't have a board of directors when you are a private company. You just have to deal with yourself and maybe a few other partnered owners or a very small group of investors. Finally, number three, privacy of business affairs and earnings. So the same way many people don't like to reveal how much money they make in a year or their year's salary, it's the same thing for a business. Many private companies don't want to go public because they want to keep their earnings private. They don't want investors to know if this month they made 2% less than last month, because that would influence their decision on whether they want to invest in the company or not. Finally, we have the cons. Number one, there's a possible major monetary loss. So basically, if the company doesn't do as well as planned, the owner who owns the complete business, or a very small group of individuals, will lose a lot of money rather than it being spread out throughout investors in a public company. And number two, you have a lack of capital for expansions. Since you didn't IPO, or you're not public and you don't have money from the actual investors, if you do want to expand, you'll have to use your own money, and therefore that could be a problem for some businesses, and that's the major reason why a business would go public in the first place. But that's pretty much it, guys. Thank you guys for watching. Don't forget to leave a like and subscribe down below. New videos will come out every single Tuesday at 9 a.m. Eastern. I know I changed my schedule a little bit, but that's what it's going to be from now on. New videos every Tuesday, 9 a.m. Eastern. Okay, guys, see you in my next video. Have a great day.